The Ryder Shoe Store Company prepares monthly financial statements for its bank. The November 30th and December 31st, 2024 trial balance contain the following information. You see that information in this first table. So we've got 4 accounts. They're showing us the debit and credit balances as of the end of day on November 30th and the end of day on December 31st. Now, they also give us 4 additional pieces of information that you can see to the left of my mouse there. A, the December income statement reported $2,700 in supplies expense. No insurance payments were made. $13,500 was paid to employees during December for salaries. And finally, on November 1st, 2024, a tenant paid Ryder $5,100 in advance rent for the period November through January. Deferred rent revenue was credited at the time cash was received. Okay, now let's look at our requirements. First, we're going to use the information and we're going to complete the T accounts that you see below. The beginning balance should be the balances as of November 30th. And then we'll prepare adjusting entries. That's the second point. All right, so let's enter the beginning balances. Now, beginning balance for supplies is given as $2,200. So if I eliminate that block, we see the $2,200. The beginning balance for prepaid insurance, $6,700. That's also a debit, so it goes on the left side. Salaries payable, which is a liability account, has a credit beginning balance of $13,500. Let's bring that to light. And deferred rent revenue had a credit balance of $3,400. Okay, there's our $3,500 and the $3,400. So that's the beginning balance. Then we need to go through these transactions to figure out what happened. Now, typically what we do is we work the transactions first and then post them to the ledger. T accounts represent the general ledger. So let's slide on down and let's look at our entries. All right, the first entry, December 31st. What are we looking at? The income statement reported $2,700 in supplies expense. Let's see if this one was our $2,700 supplies expense. Now, we started off with $2,200 of supplies, but we had $2,700 in supplies expense, but we ended with $3,700. Okay. Oh, by the way, let's go ahead and drop in those ending balances since they gave us that information, and that will help us work through the transaction. So the ending supplies was $3,700. The ending prepaid insurance was, what is that, $4,850? Now keep in mind that when you're actually doing this as an accountant, you don't have the ending balance. You have to do the transactions and you compute the ending balance. But this problem is designed for you to think about what impacted the various accounts. So they gave us the ending balances. All right, salaries payable ended at $15,007, and the ending balance of deferred rent was $1,700. All right, so now when we look at that first transaction, December income statement reported $2,700 of supplies expense. All right, if we started with $2,200 and we ended with $3,700, that means we must have purchased additional supplies to get us to $3,700, and then we had to use various supplies during the period. Okay, so let's focus on the first transaction. The December income statement reported $2,700 in supplies expense. What they're telling us is that during the regular transaction process, they recorded $2,700 in supplies expense, not part of the adjusting process. And we're focused on making adjusting entries here. Remember that adjusting entries never involve a cash account. Okay, now, if they recorded $2,700 in supplies expense, then what they did is they increased supplies expense with a debit and credited supplies. So we know that during the period, we'd see a $2,700 credit. Now, if we started with $2,200 and we ended with $2,700, then what that meant is that we also must have had a purchase equal to a dollar amount, so that $2,200 plus whatever that dollar amount is, less $2,700 is $3,700. Now, working the math backwards, that amount has to be $4,200, right? 2,200 and 4,200 gets you 6,400 minus 2,700 gets you 3,700. So we're forcing that $4,200 balance right to the left of my mouse there. Now, in this instance, there's no adjusting entry. We're just filling out the T account. They made the entry to supplies expense as the normal course of business throughout the accounting period. All right, let's take a look at the second one. It says no insurance payment were made in December. So prepaid insurance went from $6,700 to $4,850. So that meant if we started with $6,700 and ended with $4,850, the difference had to have been a reduction. Since prepaid insurance normally has a debit account, we need to have a credit of $1,850 to get us to the $4,850 balance. Now I slid on down so that we can see that $1,850 is an adjusting entry, right? They told us a beginning and ending balance. There was no transactions. So there's our $1,850 where we're going to record insurance expense and credit or reduce prepaid insurance. So that reduction there, that credit, this is where we record the transaction and then it gets posted to the general ledger. And in our instance, we're using T accounts to represent the general ledger. So that's where that $1,850 comes from, right there. All right, let's slide back up a little bit. Okay, let's look at entry C. $13,500 was paid to employees during December for salaries. Okay, now when we make a payment to salaries, we typically are decreasing the salaries payable, assuming we already accrued for the salaries, and then we're crediting cash because we're making the payment. Okay, so the way this typically works is we get to the end of the payroll period and the business accrues for salaries, but they don't pay the employees for some time. So at the end of November, they had already said, hey, we owe, at the end of November, we owe employees $13,500. What that meant was they already debited salaries expense and credited salaries payable. And now we're paying the $13,500. So we will reduce salaries payable and record salaries expense. Now, this isn't part of the adjusting entry. Okay? That's not part of it. But then we look ahead and we say, but now we owe $15,700. So the adjusting entry we need to make is to record salaries expense for what's now owed at the end of December of $15,700 and credit salaries payable of $15,700. Okay, so there's our $13,500 going away, and now here's the posting of that $15,700 from here, right above my mouse to right above my mouse. Now, let's look at D. On November 1st, the tenant paid Ryder $5,100 in advance rent for the period November through January. Deferred rent revenue was credited at the time cash was received. So what they're telling us here is this. The tenant paid us $5,100 cash, so we debited or increased cash, and we credited an account called deferred rent revenue. Okay, now let's look at this. $3,400 and it goes to $1,700. That was what they told us the entry was made. It was for $5,100 and it covered November through January. Now, $5,100 divided by 3 is $1,700. So what they're telling us is they already recorded 1/3 of the 5,100 as revenue in November, and in December it dropped another 1,700. So what we will typically see then is our adjusting entry is that we're going to reduce our deferred revenue, and that we do that with a debit, since deferred revenue is a credit account and normally has a credit balance, by 1,700, okay? And then the offset is we get to record the revenue. During December, we now earned 1/3 of the full amount. What was that? 5,100 that was given to us. Okay, and that's what's required to tackle this problem.